Hey everybody, this is Bill Black with Northwest Funding Group. Wanted to go over this consumer price index numbers that just came out today, a little bit about inflation and some of the great best practices that people are implementing based on the facts of lower interest rates in the future. So, what is the CPI? The CPI is a list of the items up here on the left-hand side. So it's basically everything that people spend on a monthly basis, and they try to track that on a monthly basis. And then what they do is it's a 12-month rolling average. So as you can see here, this gray line here around 2008, that's when the housing market crashed, and we kind of saw this the CPI number drop down. Everything pretty much nobody had money to buy anything, so prices dropped, unemployment dropped, or unemployment increased, and jobs went that bad. So kind of went down, and you see this negative number under zero. As we recovered, we bounced around right between 0 and 5. The government wants us to try to stick around a 2 to 3% inflation, nothing any higher. So we fast forward up to the next gray line, and you see that is when COVID happened, and basically kind of people's like freaked out. They didn't spend any money, and then you see where it starts going up. That's when money started being printed. So unemployment occurred, and money was be giving out, and as fast as they could be giving money out, people were spending it. And as we keep going up, mortgages were not need to be paid, credit cards were not need to be paid, student loans were not need to be paid, and so people were accumulating cash. You get up there to around the peak almost, maybe around August of 2021, and what happened was that was the largest amount of savings in the history of the nation. A couple months later, all of that money, people were basically not having to work, getting, our daughter was making 225 a week, and unemployment happened. She's making 750 a week. So she was it was almost encouraging not to work versus take that unemployment. So it really created the inflationary issue that we have today. So as that money, as those funds have dried up, unemployment's dried up, the COVID funds have dried up a little bit. So people have no longer getting that free money. The savings has depleted. Credit cards has increased in the last 90 days faster than it ever has. Not just that, but today we just found out that the average interest rate on a credit card is 20.04%, highest it's ever been in history. So what's going to happen is basically the overspending, the big, it's kind of like we had a party, there's a hangover, and it's time to sober up. And that is going to lower inflation. So what the CPI number is based on is a 12-month rolling average. So when December's numbers come out, we had zero point zero 0.06 plus all of these last 11 numbers right here equaled where our CPI number was. Okay. So we remove zero point zero 0.06 or zero point 0.6, and we add negative zero point 0.1. So things have slowed down in December, things slowed down in November, and you can see the 0, 1, all the last 6 months, we've been under 0.5. You can see since 2012 to 2020 that zero point 0.5 was the highest it was. Well, there's a 0.6, so zero point 0.5, so that zero point 0.6. So the zero point 0.6 was about the maximum. Then it went to 0.5, 0.3. So it always averaged out right around, pretty flat line, maybe, really minimal. So we have a 12-month rolling average right now of that we're including. What that means is as we go into February, as we go into this month, January, and whatever happens in January of this year, we're going to replace the zero point 0.6. February, we're going to replace 0.8. March, 1.2, and 1.3 in June, and 1.0 in May. All of these are going to be dropped off and replaced as prices drop, as our supply chain issue is gone now. There's no more ships being backed up into the ports. As our wage increases stabilize or drop. No longer is it better to get unemployment than it is to work at a fast food restaurant. So people are running out of money. They're maxing out their $3,000 credit cards. They're stopping their Uber Eats. They're stopping their eating out. Their spending habits have to change as they kind of have that hangover that they have to correct from their big party that they were at. So that's going to slow down the inflation that we're causing, that is being caused by overabundance of money. And the feds keep increasing rates to try to make that happen. So what's going to happen is when this inflationary average number drops, then the Fed stop increasing rates, and we're going to see them come back for the first time in a long time and say, oh, look, we have a 7-8% rate. We can drop that down. We see these unemployment numbers coming in, and these tech jobs are being lost. We're going to drop from 7-8%. We're going to drop down to we'll drop 2%. And instead of increasing these rates, they're going to decrease them just as fast to get the economy going again. And that's kind of why a lot of economists, including myself, feel that we're going to be seeing some really good improved rates just as fast as they went up. We'll see them come down. So with that, the one of the numbers that was in this mix today of the economic indicators is around shelter. Really track these numbers probably way deeper than I really should, but we have shelter in costs highest has been in 38 years. And so the problem with this shelter issue that we see right now is it's kind of a black swan event. So what happened during COVID and is a lot of the investors have sold their homes. They were not getting rent, even though they didn't have to pay the mortgage. They might have something free and clear, and the tenants, they didn't have to pay the rent. So if the rent didn't have to be paid, the mortgage didn't have to be paid, the money wasn't coming in. They just said, what, screw it. I've had this home long enough. It's I'm out of my depreciation mode, and I just want to sell it and move on, or do a 1031 exchange and get out of it and get something different. They sell a $300,000 house that's renting out for maybe $1,500. They'll sell it for $300,000. Someone will come in and put $50,000 into it, clean it up, make it nice, and all of a sudden rents go from $1,500 that someone lived in for 5 years at that rate all the way to $2,000. It's a 25% increase in rents. So now all of a sudden throw that 25% increase into these economic numbers, and it looks like rents is just skyrocketing. The actuality of a person that is in an existing home is maybe 3 to 4% increase in rents year over year, not this 20-25% that we're seeing. The other side of that is what was happening during COVID times is the people that before these investors started selling in the last 6 months, any house like that, any type of a rental came up when rates were 3%. There was 26 million people available to purchase a $400,000 loan back when rates were 3%. Every time rates improved or went higher, we lost about 2 to 3 million. At 7.25% rate, we only had 11 million people that were eligible to buy a $400,000 home. Today, we're back to 6.25, maybe a little lower. Now we're from 11, we're up to 12, 13, 14 million. And as we go to 5.25, we'll be back up to 16, 15, 16 million. So 1% of a rate is a 3 to 4 million people in or out of the market. So back when rates were 3%, we had this huge amount of people, 26 million people were looking for a home around 500,000. And that's why you have cash buyers won those homes. That's why 20% down, fast close, waiving appraisal. You had 15, 20 people trying to get in a batter box when you only really need 3 to be able to hit the ball and make a home run. So this is why I feel like it's a really great time for people that are not cash buyers, that are not, looking in to come in and flip a property in 6 months. In order to buy today, utilize our programs that we have for first-time home buyers and our veteran programs for lower down payments and not have to really compete as much. So what's going to happen is as these rates drop, which kind of show you a little bit how inflation tied to the Fed market, tied to the bond market is going to get our rates back to 5.25-ish, how that's going to put millions of people back in the market. It's going to fill up the batter box again. And those people that said, oh, well, I'm going to waited too long, and they missed out on being able to hit a home run, buy a home. So this is a little bit more showing why I feel like those numbers are lagging around shelter. The U.S. apartment leasing traffic plunges to the lowest level in 10 years. So this number right here, we saw that the amount of people coming in looking at properties steadily increased, and all of a sudden it's falling off like nobody's business right now. And that means that they're not looking, so they're not renting. And so we're going to see a slowdown in August of last year, 2022. I feel, and all of the data shows, that was a peak of rents, and they're going to start correcting. And why I think they're correcting is what I see today is more and more people that are ready to move up to the next home have a 3.5% rate. They come to me and they say, "Hey, Bill, we're ready to move up, going to a $500,000 home. We're selling our, 2 bedroom, 2 bath. Our kids are getting bigger. Okay, great. You got, we did a great job. You got to, we refinanced you at 2.5, 3% rate back when it was time. So now you got 200,000 of equity. We're going to put 200,000 of equity on a $500,000 loan. We're going to put you back to a $300,000 balance. Great. But when rates were 7.25 and they were at 3%, I'm going to double close to doubling their payment, almost a $3,000 house payment. And they're only paying 1,600, and they're like, that's way too much. So we wait. Now we're 6.25, and so what they did was either we wait, or they say, I got some money, I got some, we have both have really good income. I don't mind putting 3% down, 5% down. So they keep that house as a rental. The last 6 months, we've seen more first-time investors being being landlords than we have in the history of my 18 years of doing business. What does that mean? Saturation of rentals all of a sudden lowers the amount of rents. So that peak of rents is going to go down just as fast as it went up. Like everything kind of levels out. And these CPI numbers being reported for the 7.5 that you see here, where is it at? Rent on primary residence, 8.3 year over year increase is going to drop substantially. Okay. So this is a lagging indicator that's going to go back to this number. This number is going to drop. So one of the reporting numbers for shelter is going to add to the lower CPI. The only thing that's really going to mess us up here is one of the things that's really improved is gas costs under energy. If gas shoots up to $5 or $6 a gallon, it's going to offset anything that this saves here. So, or any other black swan event, anything going on with Russia and Ukraine, or maybe, the China, Japan issue, any kind of thing like that puts us back in, God forbid, another COVID, anything like that could throw all of this plan out of the mix here. So with that, how does this affect our rates today? So I follow two things. I follow the 10-year Treasury, and then I follow the mortgage-backed security, the 30-year mortgage-backed security on the 5.5% coupon today. How did this news of this inflation of the CPI numbers affect us? It lowered the 10-year Treasury by 12 basis points. So that means we are right here, and this floor right here is 3.431. We're touching the floor. Last time we touched the floor, we dipped under it and all of a sudden bounced off. We touched the floor again, we bounced off. So in the last 90 days, if we break through this floor, the next bottom is 3.266. That's the 200-day moving average. So there's a clearly between 3.4 and 3.266, we have almost 20. I mean, that's not too far away to drop and make this. Once we get to this, the sky's a limit of, I should say the ground's a limit of how low we can go. So this is a good sign that we are heading the right way in the right direction. The other thing I look at is the mortgage-backed security. We've improved 33 basis points today. What this means is if you bought $100,000, if you wanted to buy $100,000, a 5.5% bond based on a 30-year mortgage-backed security, so it's securitized by mortgage loans, you're going to get a 5.5% return. For $100,000, you pay $101.72. Back here, when rates were 7.25, we didn't know how high inflation was going to go. Things were out of control. Is it going to go 8, 9, 10? What's going to happen when things were out of control? Nobody was interested in buying this, and you would pay, and you could actually you would be paying 90. It was 97. It looks like $97 for a $100,000 coupon, and so that means that had to offset rates. We were probably at 7.25 right here where rates were at. As we stabilize the inflation issues and show that we're not going to have some skyrocket 10% rates, then it's more interest to buy back into these mortgages. As these mortgages purchased here, we can see that we hit this ceiling right here. That's 101.671, and didn't break that ceiling. Bounced back down, hit it again, bounced back down, hit it again. Here, bounce back down. We're currently cresting it right now at 101.72. It was 101.671. So if we close by the end of the day today, breaking that's a really good sign. The next move, so we're already above the 25, 50, and 100-day moving average. Our next move is the 200-day moving average up here. So just like the 10-year, we got a little ways to go. But if we continue to be in this area right here over the next couple of days, we have room to continuously climb and see some rates in the 5% by maybe even by next week. So just in showing how fast rates go up, rates go down. On the 5th of January, rates sitting about 6.5%. Within that period of time of 1 week, we're already down to 6.07 on an average. And so this is the overall numbers for the 30-year fixed here. So a really substantial improvement. This is real close to edging. I mean, I think that probably, there's some lenders out there that should be real close to a 5.99 today. We may even be able to, I'm not sure, we have to look at the rates, but this is a really good sign. Almost a half of a percent just in a week by identifying and understanding the market and when to lock, when not to lock, when to float, and where things are heading. Back to the mindset of if 2 to 3 million people qualify with every 1%, that means in 1 week there's about a million and a half more people are eligible to buy. Imagine when there's 5, 6, 7, 8, 9, 10 more million people that are able to buy. It's going to create another hot market come this spring and this summer. So that's why I can continue to encourage people that this is a really, really great time to buy. And so, when these rates are down this low, this is a really super, super good time. But rates aren't so low, like in the 5.25 on the 15-year, that we want to do. So what do we think? This is, again, estimates are in the 4.5%. I'm going to be conservative and say 5%, 5.25. 2023 will probably have some bouncing around, but that's kind of where they may go. But if a person's looking to buy a home, unless they're a flipper or unless they're planning on only living in it for a year, which I discourage even buying a home if you only plan on living in it for a year, then these rates really do not mean anything today, because we know we're going to see lower rates. I'm going to offer a refinance them at a no cost refinance eventually, and maybe even a couple times as rates drop back down, and save them some money every time we go through that. So the number one thing due to that information around rates dropping, what I'm really encouraging people to look at is our buy down. Now, most places have a buy down where you pay $10,000, you drop your rate from maybe 5.99 down to 5.5%, save about $150 a month, cost you 10 grand, takes about 5 to 6 years before you recoup the savings. And if you refinance, you're going to lose your money. We have something better than that. So what this program does is we put so this scenario was a 510,582 purchase, 5% down. I just happened to be able to lock in at 5.99 around the middle of December. It was like maybe 1 or 2 days of that. And so the seller gave a contribution of 2.1% or $10,754. That goes into an escrow account. So when the client went to the credit union and got a quote, they came back with $3,900 was a total quote for payment on a $510,000 purchase. And they were like, what, I can rent for $2,900 for the same exact brand new home, so I'm not going to do it. Well, after running an analysis, going through some options, looking at the programs, looking at this 2-1 buy down, what I'm able to do is put $10,754 into a side escrow account. Their payment drops from $2,905 without taxes and insurance, HOAs and all that. It drops down to $2,312. So their payment has dropped $592 a month with this program right here. And so every month, instead of paying the $2,905 plus taxes and insurance and everything else, which was about $3,500 or something like that, they're paying $2,312 plus those taxes and insurance. So they're saving that money. And then year two, and so that's equal to a 3.99 rate. Year two, they're paying 4.99 payment at $2,600. Now, the cool thing about this is if what we see is an estimation of probably around May, June, we're going to be back to low rates. I will refinance them in 6 months from now, and I only used 6 times 592, about $3,600 of the 10,754. I'm going to refund them to the principal amount of their balance owed in 6 months. I'm going to give them about, if I use 3,600, I'm going to give them about $7,000 uh, to the principal. So they don't lose any of this money. They're just getting a lower rate. And what they don't use, we go right back to the principal of the home and drop the value or drop the payoff by that amount. So it's a really, really great, incredible program. And like I said, I keep hearing more banks and credit unions and lenders that do not offer this. So it's kind of a unique program. Brokers, we this one of the benefits of being a broker is we find the things that work in the markets that work best for us. So hopefully that information right there will will help, and to understand that currently, things are looking good. I'll continue to report on how we're doing on these mortgage-backed securities, but I mean, I really feel like we're going to be 5%, or in the 5.875, 5.99 as soon as next week if things continue. So if you have any questions, feel free to reach out anytime. My contact information is right here. Bill Black, 360-910-3290. Thank you and have a great day.